But let's address another set of earnings. We've got the management of GE Shipping joining in. G. Shivakumar, the Executive Director and CFO, here with us. Mr. Shivakumar, hi, great to have you on the show as always. A decent growth is what you've posted in the second quarter, both the top line numbers, but the operating performance and the bottom line remains a little bit under pressure. Tell us, what were the key operational challenges that you saw this quarter?
Yeah, good morning, and thank you for having me. Yes, we had in the tankers, we had a slightly soft quarter as compared to the immediately preceding one. So versus Q1, it was stronger versus the previous year uh, in terms of the realizations. The spot markets have been a little weaker for the tanker markets. Again, this is the normal summer seasonality that we see, maybe exacerbated a little bit by poor refining margins, and you may have seen that in other companies' results as well. So uh, a lot of the tanker trade is strongly correlated with refining margins. So that resulted in slightly softish trade, which resulted in slightly lower realizations for tankers on the spot market. And again, a lot of our tankers are exposed to the spot market.
But what's the visibility going forward for the third and the fourth quarter? How is it that you're seeing your EBITDA margins trajectory building up from here on?
So we still have a significant spot market exposure. The one thing that we are seeing, which is encouraging, is the refining margins have been trending up for the last couple of weeks. Not yet seeing filter through strongly into the spot market rates, but hopefully, if this continues, then you will see the impact on our earnings as well. Otherwise, in general, the demand for oil has not been as expected. Oil consumption demand has not been as expected. That's what's been the significant disappointment of the last couple of quarters.
Has been disappointment, and that's why we haven't seen crude price run away despite the kind of chatter around supply disruptions, etc. But talking about the dry bulk segment now, with Trump coming back in terms of the presidency in United States, what could be the implication on global trade? Because that's what everyone is worried about, and it seems like there's going to be greater curbs. What does it mean for your dry bulk business there?
Yeah, so let's look at what happened the last time we had those tariffs. Again, the dry bulk trade could have tariffs, could be affected by tariffs to the extent that grain exports. So last time it happened, we had the US putting tariffs on Chinese finished goods coming into the US. In retaliation, China put tariffs on US grain, and which resulted in less imports from US for China. However, the demand was still there in China, and the supply was still there from the US. So it just that the trade patterns changed a little bit. In fact, sometimes when you have these tariffs coming in, if the underlying demand and supply remain the same, then all that happens is that the trade pattern gets less efficient, because if without all these external factors, everything works to the most efficient way. So the last time we saw cargoes going from, say, South America to China instead of from US to China, and US was exporting elsewhere.
Okay, but have you seen any initial signs in the dry bulk freights at the moment, or the rates that are being tied up for, let's say, the medium term?
No, not at all. It's just too early, and that would happen only after the news comes. Today's market is driven by today's demand. The spot market is driven by today's demand of how many cargoes are there to carry and how many ships are there to carry those.
Okay, fair enough. You haven't seen a big impact at the moment, but you of course have been utilizing this time to upgrade your fleet to that extent, kind of getting some of the newer ones and letting go of the old ones. You still have significant cash on the books. What's the plan further? Are you looking at making some more transactions when it comes to your fleet?
We are waiting for prices to come to our levels before we do a significant expansion. So you rightly said that we have just been doing replacements and refreshing the fleet. We have been selling the older ships and replacing them with more modern ships of the same kind. To do a significant capacity expansion, we will need lower prices, and we'll wait for those prices. We know that cycles play out. It's a question of when the cycle turns, and we'll wait for those prices in order to invest in a big way. In the meantime, since we are in different sectors, the dry bulk market is not as strong as the tanker market, so you could get opportunities to buy in dry bulk while you wait for opportunities to get tankers at good prices.
And before we let you go, sir, then what are the next triggers that we should watch out for your company? Of course, a lot is dependent on the spot rates that you talked about, because you do have exposure still there. But what are you doing in terms of accelerating growth from here on?
So we can't control the rates because we are a price taker. It's a commodity market. We are a price taker. We'll be looking for opportunities to do capex. If the market comes off, and if the tanker market specifically comes off significantly, and that has its logical impact on asset prices, then we'll be there to buy, which will result in the next phase of growth in capacity. And so that's what we'd be looking forward to. In the meantime, if rates remain strong, we keep collecting cash. If we get opportunities in other sectors, we will go and buy ships in those sectors. So the triggers really, and from the market point of view, the triggers would be if OPEC comes back with increased production, then that means more oil in the market, which is good for tankers always.
Okay, Mr. Shivakumar, good luck for the future quarters and good chatting with you as always.
Thank you.